I'm making this video to try to help you because the reason why is that I personally believe that we have not seen the lows of this bear market. I think you could see the market go a lot lower from here in the coming weeks, months, quarters ahead. And so a lot of folks should prepare for what that looks like when you're looking at your holdings now, and what if they are significantly discounted further? Are you going to, if you're dollar cost averaging, are you going to keep dollar cost averaging? What if, you get fired from your workplace? Are you still in a position to dollar cost average? I personally am not of that mindset. My personal mindset is I want to swing when there's incredible opportunities. And when there's incredible opportunities, then I go, oh yeah, all in. And I'll go all in on 5, 10 companies if the valuations are just crazy compelling. So the reason why I'm making this video is try to help you out, saying, look, this is not financial advice, but this is me warning you, saying, look, a lot of people, I got the phone calls when I was in March 2009 from friends, from teachers, from acquaintances saying, Daniel, I just liquidated out of my portfolio. And that was the exact wrong time to do it, but they just couldn't take the pain anymore. And so that's the reason why the time now to prepare for potential lows from here, significantly much lower lows than we currently have experienced, the time is now, because if your pain threshold is right here and we're about to blast through that, I don't want you making an irrational decision. Just waiting to that point of capitulation, and that's the point when you dump everything. And ultimately, you might be the one selling to a guy like me who says, oh man, I can't wait for just incredible bargains. So that's the reason why I'm saying have a plan now for what you're going to do, especially if this bear market is just getting started. What is your plan? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel. Let's discuss the current market and how, why do I think that, the bear market's just started? What's going on? A lot of folks might say, well, wait a second. You look at these innovation funds like what you're looking at with, Cathie Wood last year, down 70%. How can it go much lower? And I'm saying, buckle up, man. I gave a warning in February of last year. You can see that video. You can see, it's like, ARK, watch out. And I nailed it, folks. Within a week or two, ARK peaked, subsequently down about 70%. That video was very well timed, nailed it. And so now I'm saying, you know what? Things could get worse. And part of the reason why is the setup here, which is that you have liquidity getting drained from the system. You have the Federal Reserve looking at this saying, hey, inflation's just too darn high. We got to address it. And as you have the Federal Reserve sort of tighten the system, whether or not it's raising interest rates or whether you see it with quantitative tightening, that is a huge headwind for risk assets. And so I see this, continued pressure, particularly for the growth, no profit companies that, could continue coming under the gun. And arguably, you could see everything come under the gun as you still have the pressure of inflation. So you have valuation compression. You also have the risk of a recession and what that means to demand, what that means to valuation multiples. You're just going to get hit all across the board. And anyone that's just like, oh yeah, dollar cost average because I know it works out over time. How did it work out for you in, let's say, the 1970s? And so if your model is solely predicated off of the mega bull market that occurred since, let's say, 1982 till fairly recently, I would say you need to check your assumptions. You need to broaden your history book and say, wait a second, there are periods, where you can go 15 years where, let's say, commodities outperform stocks. And that's just an unfortunate reality. So for all those folks, I'm just keep plowing ahead in the index funds. My personal view is it's better to have a fundamental analysis saying, hey, I'm going to swing when there's a great bargain. That's my own personal, approach. Everyone needs to figure out what's right for them. But part of this is warning you, saying, are you going to do the right thing when you've reached max pain? What happens when, the market's down significantly? Not only the growth stocks, but the whole market. And that's part of the concern here is a lot of people are like, oh yeah, we've seen a market crash. You see Jamie Dimon, head of JP Morgan, talking about bracing yourself for an economic hurricane because of these very same factors, quantitative tightening, the inflationary pressures. But the reality is S&P 500, it's still, it's not even down 20% from its high. This is not a market crash, folks. This is a warm up. And that's, I think, really important for folks to wake up to. And you will not see the bottom, in my opinion, until you see outflows. Despite the horrendous performance in the ARK funds in the last year, what you still see are inflows into the funds. They talk about how while all 9 ARK ETFs have posted double-digit losses in 2022, dragged down by declines in richly valued technology shares, the lineup of various different ARK funds is still clinging to net inflows of $167 million. You do not see bottoms until there's forced selling, until the holders of speculative securities are forced to sell because their investors are pulling capital as well. And once that happens, that's when you have capitulation. That's when valuations hit their bottom. We are nowhere near that yet. And I'd arguably, looking at the valuations, the S&P 500, 21 times earnings, trailing earnings, is that really appropriate? Potentially facing a recession? I don't think so. And I think if a lot of people look at the S&P 500 as a real company, if you were to say, hey, here's a company that, let's say, grows earnings at 5-6% over time, pays like a under 2% dividend, is that worth 21 times earnings? Most people would be like, no, maybe like 15 times. In which case you'd go, holy smokes, there's a lot of downside here. And so you look at this is effectively another warning video. And I respect the folks that have done it for a real long time. I really respect, Stanley Druckenmiller. He had something like crazy track record of something like 30% for 30 years. Just incredible, never like one single down year. And what's he talking about earlier today at a Investor Zone conference? He's talking about how he's looking for opportunities to short stocks in the dollar. He's saying, look, you're likely to face a recession, within 2023. And he's saying if you're predicting a soft landing, it's going against decades of history. And so this is, I think this is the intelligent way to invest. Like when I read this article earlier today, it just popped out because I'm like, this is what I've been saying for weeks, folks. Like whatever, bear market rally, I don't believe it because the fundamental pressures of monetary tightening, also the stimulus, also, no longer you're lapping that pressure as well. You no longer have that stimulus bump. So effectively a twofer challenge, both the fiscal and the monetary. So I'm looking at this and saying, so you have these pressures, and the Fed has no wiggle room to not tighten, even if the market tomorrow were to open down 20%. Would the Fed really be in a position if the Fed saw continued high inflation? Would they be in a position to be like, oh yeah, we're going to loosen things up even if the market fell 20% tomorrow? I don't think so. Until inflation is under control, the general monetary tightening is going to put the screws to stocks. And that makes it a very tough picture. And that's what Stanley Druckenmiller, arguably one of the greatest investors of all time, he's looking at liquidity. He knows liquidity drives markets. And he's saying liquidity is getting pulled. The cash is getting pulled from the system. This is going to hurt stock prices. So he's not looking to buy right now. So all those dollar cost averaging folks, he's looking to short. You're going against one of the greatest investors of all time. Now, you might say, Daniel, I don't care. This is my journey. And I say, God bless. Good luck. But it is worthwhile to understand, who are the different players at the poker table. And this is arguably one of the greatest investors of all time making this call. And I strongly agree with it. I don't see how the liquidity picture improves significantly in, let's say, the next few months. So this is just my take. If you're looking to take charge of your investment journey, consider unrivaledinvesting.com, where you'll get actionable insights on unrivaled companies. We also have a community of fellow investors that you can learn and share with. I also share my own personal journey for those interested in following along. I share how I'm personally investing through this period. Part of it, even though inflation is eating away at it, I would rather have cash. So I do have a very sizable cash position, even though it's losing purchasing power potentially by the day. It can hold up better than stocks in a period where liquidity is getting drained from the system. Longer term, do I want to continue holding cash? No way. I want to own it in great companies at compelling prices. And arguably that's what I'm trying to do at Unrivaled Investing is, every week try to call out, turn over stones. Here's a compelling company. Here's why it's compelling. Is the price right? Maybe. Here's the upside potential that I'm penciling out. Nah, is it not there yet? Not there yet. Oh, now's the time to buy. So I look at it, and so at this point, I am not going like, yeah, valuations are crazy. It's this is the time. No. You're looking at one of the greatest investors of all time, Stanley Druckenmiller, and he's like, yeah, I'm looking to short right now. I'm trying to figure out ways to bet against this market. So I think that is a data point that a lot of investors are worth thinking about, worth considering. If you found this video to be helpful, I'm not trying to be, creating the fear. I'm not trying to, oh my goodness, like what's going to happen? All I'm trying to say is that if there is significant lows from here, which is what I personally expect, and effectively what I'm betting on, if that happens, are you prepared for it? I know I'm personally prepared for it, and I have my different plans of like, okay, I have this cash that I'm ready to deploy in XYZ opportunities. If they hit these prices, man, I would love it. But otherwise, I'm going to sit tight. And you also never know what opportunities you'll get. So it's important to have that cash for optionality. But yeah, I also do have hedges against the market. So I'm aware of that. And so this is how I'm personally positioned. This is how I'm thinking about it. And I'm not trying to scare you out of it. Like if you're going to just keep plowing money away and say, hey, I'm going to be buying XYZ stock, and you have a good reason why, great. But I think it's so important to know the thesis on why you own things, how comfortable you are that the company will perform throughout a recession, how strong the company will perform with potentially higher interest rates. Does this company have a lot of debt? What if they have to refinance their debt at higher interest rates? So you have the checklist of challenges are much higher than normal in this period, especially when cash is getting pulled, liquidity is getting pulled from the system. So if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thank you so much for tuning in.